Welcome back to It's Only Money with financial advisors Scott and Tammy from Edgewater Family Wealth. EdgewaterFamilyWealth.com is the website you want to go to for all your financial needs. And if you want to get links to past shows, hey, we're on all the podcasting and streaming networks, including the iHeartMedia app. Check it out there. Good morning, Scott. Good morning, Tammy. How you doing, gentlemen?
Good morning.
Good morning. Buenos dias.
Buenos dias, indeed.
Buenos dias. I like that.
Tammy speaks like 8 languages. It's like he's impressed by my one phrase in Spanish.
Yeah,
It sounds so authentic.
It is authentic. I'm authentically bad at it.
I love that you're fascinated by the Spanish. You didn't learn Spanish also, Tammy, to come to Florida?
No, before coming over, a friend of mine who used to come to the States quite frequently, she told me, you better learn some Spanish because it's going to be very useful. Many people there. But me, as an ignorant foreigner, I don't know. So when I arrived here, I should have learned some Spanish.
How many? What languages do you know?
I know a few.
Yeah, okay. He's not going to brag, so he knows a few. Yeah, so don't try to talk behind his back. It isn't going to work.
I will not.
Yeah.
But I'll try to figure out one that he doesn't know. I'm gonna go Japanese.
Most of them I don't. Let's start there.
That's fair.
Well,
That's
I
fair.
barely speak English, so you got me beat for sure. And you don't only speak English and several other languages, but you also speak in numbers, Tammy, if I am not correct.
Yeah, of course, of course. And to that point, I heard that some people added letters to numbers.
Yeah.
Ever seen that?
I've seen that. That's called algebra.
Yes.
Yeah, I quit. I don't care for it. The second year at school and they start adding letters to numbers, I'm tapping out. I'm out. I don't know what you're doing now, but this is too much.
They're not supposed to be there.
Yeah.
Don't mix them.
It's the alphabet, and then there's numbers. It's right there in kindergarten on 2 different pieces of paper across the top of the chalkboard.
That sounds like something like an old-timey man would yell like, my day, letters were letters, and numbers were numbers, and they did not mix.
No, I agree. I agree with that.
Then all these letters started moving to the numbers neighborhood, brought down the property value.
Numbers and letters. Never the twain shall meet.
Yeah, right. Speaking of value, we looked at the CPI. Here you go. That's a great segue. We looked at CPI. The last one, it's below 5 for the first time since, can you guess when?
Since pre-COVID.
Almost there. Since May 2021.
Okay.
So we're back 2 years now when it comes to CPI headline.
Right.
So the fight against inflation is going the right direction.
Does the Fed know that?
They did, actually. They did. We listened to Christopher Waller, and he's one of the...
Wow, hi, I'm head of the CPI.
I knew that was coming. I knew it. As soon as you started down the Christopher with a W, I'm like, here it comes.
Wow, inflation.
I'm walking in.
Oh.
I'm so sorry.
It's okay. The Christopher Walken impersonation is always welcome.
Yeah. The only difference, that guy is Waller, not Walker. But close enough. One letter.
Close enough.
It doesn't matter. So why do we listen to the Fed? First of all, they have a lot of governors of the Fed system, and they come up and sometimes they have speeches regularly.
Yep.
And it's always interesting to listen to them because they give you an insight on what the Fed is thinking and how they see the economy, the data that comes out, etc.
So what do you think they're seeing?
Well, he bluntly said it. Like he said, "Oh, I didn't expect the economy to do so well." He said that bluntly. You can see it.
Oops.
So he said, "Well, that means that we can raise rates even more because that means the economy is not as bad as we thought." So that adds on to the movement that go in that direction.
So one of the things that's been bantied about amongst Fed governors, and I think even Janet Yellen, was that the most recent issues with banking seems to have squashed some of the fervor in the economy, if you will. So do you think the Fed will take that into consideration? Some people are saying that could be a substitute, the bank problem, that is, a substitute for another 25 basis points. I don't think so, would be my guess, and I almost hope not, because I still think the Fed has a little bit of work to do in terms of slowing the economy down and also giving themselves dry powder for that day when they need it.
Exactly, and I think Waller agrees with you.
Oh,
because
smart man, this Christopher Waller.
Yeah. He said literally about the banking issue that they had. They said it's not a liquidity problem. Yeah. It's not a credit problem. It was a risk management problem for the banks themselves.
Yeah.
And he said that retail sales, the numbers are not as bad as we thought they would be. And we see people spending as much money as they did before. Well, a little bit lower, but not as bad as expected.
They go out to dinner anywhere.
Yeah.
There's people everywhere, man.
You
can't get into a restaurant. People sucking up on my table space. I thought you people are supposed to be slowing down.
Yeah. Go back to bed.
Yeah. Damn it. Get off my lawn, you people.
A great indication on that, too, that people are coming out spending, the economy is doing well. The GDP number that came out.
Yeah.
2.2 for the first quarter.
Okay.
That's incredible.
Yeah.
So we're not seeing any, the economic slowdown that is, end of days scenario, it's nowhere. We don't see anything that backs that.
Yeah.
Even bonds, they kind of, they dropped a little.
Yeah.
They're supposed to, start rallying, but they didn't because of exactly that thing. They expect more rates to come.
Yeah, so the bond market hasn't rallied because there may be more hikes to come. Yeah. So you would because you would expect the bond market to rejoice the day that the Fed pushes the pause button or even acts like they're going to push the pause button. My contention has been, and I'm notoriously wrong, but I'll say it anyway, is that when the Fed pushes the pause button, when they indicate, okay, we're good, we'll have a banner market, both stock and bond. What do you say?
I would say 100% to that because it is a unique time in history, and we're going to see some unique results.
Oh.
And unique numbers.
Unique numbers with Tammy.
I like that you put your hand up, and that's a Tammy guarantee.
Take that to the bank.
Buenos dias.
Buenos dias.
So what else you got for us this morning?
We also looked up the sectors to see how things are going. And year to date, the best performing sector is communication services along with tech.
What is, give people an example of a communication stock? Would that be like a telecom?
Verizon.
Yeah.
Verizon is a good example. AT&T.
Got it. Okay. And those are doing well?
They are doing well. We're seeing some big numbers there.
Yeah? In terms of returns?
In terms of total return.
Yeah.
Not price return.
Gotcha.
Because they substitute a lot of their returns through the dividend yield.
Yeah, a lot of telecom stocks pay a nice fat dividend. That is correct.
So it assumes that whoever invests in that is keeping that money and reinvesting their dividends.
Sure. Well, a lot of, and this is a good opportunity to stress a point that I've said before on this show, but a lot of people get all caught up in the growth of a stock. I put it in, buy a stock at $5, I want it to go to $6. Of course, that remains true, but a lot of the growth of the S&P, in fact, about 30% of the growth of the S&P historically comes from dividends, right? So if you have a stock that only goes up 2%, but you earn a 4% dividend, your total return, quote unquote, is 6% that year, yes?
Yes.
So a lot of people will say, well, I'm not going to buy a growth stock that doesn't pay a dividend. Yeah, I might get 30%, but I might get negative 30%, whereas if I bought a stock, and I'm not suggesting this is a stock to buy, but AT&T is a good example of if you bought it at 20 some odd bucks or whatever it's trading at now, it's going to pay you, 4 or 5% a year just in dividends alone. So even if it did nothing and it stood pat, didn't go up from 22 or 23 or whatever you bought it at, you're still going to earn a fairly nice dividend to kind of, bide your time.
Absolutely. And when you go online and check, say, big names, whenever, Ryan, whenever you want to check on your stocks, usually, where do you go? Do you go to google.com and then you type in the ticker?
Oh, boy.
No, I whatever app I use, I look at that.
So any app or Google or Yahoo or any platform that you use, they only show you the price performance.
Right.
They don't show you the return from dividends and how that accumulates.
Yeah, a lot of people wonder, when somebody retires, how do they get income? So if you had, I'll make up some math. Let's say you had $100,000, you bought some shares of AT&T and some other company that netted you 4.5%. If it's 5%, that's $5,000 a year. A lot of people just live off the dividends, right? They accumulate a bunch of stock in a company. I have lots of clients who retired from AT&T dating back to like the late 90s, early 2000s, and many of them had thousands of shares of AT&T. And while the stock hasn't done anything, it's been pretty lackluster, in fact. They just live off the dividend it produces. So sometimes, in some cases, that's $1,000, $2,000 a month for some of these people. And yeah, they're disappointed the stock didn't go from 30 to 40. It went more like from 35 to 20 or whatever it's at right now. That's disappointing because the net value of the stock is not very high when they look at the account, but the dividend keeps right on rolling in, and they keep right on going to dinner with it.
I like going to dinner.
Yeah.
I like my $34 when it comes in once a month. On the various dividends. That's the trick how they got me, because you're right, because I couldn't find like concrete. Just looking up ticker stocks, like if it had a dividend, and there was this time where I was investing, I was like, why would I not have only dividend stocks? Which I was told that's not the way to do it either. Just another lesson I learned the long way. But I like when the dividend comes in, but I have mine set to just automatically reinvest it.
That's smart.
For the most part, so I get nothing.
Yeah. Right now. Nothing tangible. But on your statement that $34 goes back in and buys more shares, that then turns 34 into 35 and so on and so forth. So
yep.
If I immediately reinvest it, do I have to put that in my tax info?
You do.
Damn it.
Mm-hmm. Yeah. If you get a dividend, you got to pay taxes on it.
Oh.
Well, it's the price you pay for prosperity, my friend.
It is. And if you want to pay prices for prosperity.
That didn't sound right.
That did not sound right. If you want to have prosperity, let's go there.
That's better.
EdgewaterFamilyWealth.com is the people you want to talk to. Scott and Tammy are awesome, and Edgewater Family Wealth has a ton of free tools and blogs and all kinds of stuff on their website. Check it out. And links to past episodes. Plus, you can get them all on the iHeartRadio podcast, along with wherever you get your favorite podcast. And we'll be right back with more It's Only Money. Welcome back to It's Only Money. I'm here with Scott and Tammy from Edgewater Family Wealth. If you want to get a hold of Scott Brown, EdgewaterFamilyWealth.com is the website that you want to go to. That's where you find all the info. And we left people with a cliffhanger of the numbers. 1, 2, 3, 4. I was like when we get to do the music twice.
Yeah, it's numbers with letters now. We're moving on. We're graduating.
No, I quit if you do. If you start adding letters to the numbers, I'm done. That's just like in 9th grade. I'll be done.
No, then we need Scott here. We can't do that.
Scott, go play basketball. Okay.
So we were talking about the indices on our break, and Scott, you brought the point about we said actually prosperity.
Yes.
And from prosperity, we moved on to value. Mm-hmm. Then I thought, wait, value. So we have value in the index, but
in the S&P 500.
In the S&P 500.
So there's one index, one part of the index we call value, one part we call growth. Mm-hmm. Mm-hmm. And what is the difference?
It's just a composition, the kind of companies in there.
Mm-hmm. What would be an example of a value company?
It would be a company that is matured.
Like Procter & Gamble.
Yes.
But Kraft.
A company that matured, that pays dividend.
Mm-hmm. Not a sexy name like Amazon or Netflix or Tesla.
Yeah, you would see lower growth, and the cash projection, they have enough cash to sustain them. Yeah. Their sales are not growing as much, but they're stable and strong.
Right. A lot of people Ryan's age would call this boring stocks.
Yep.
That is no meme stock, baby.
I don't want Procter & Gamble. What do we invest in? Baby powder?
Well, what do they even make except
everything ever?
Everything everywhere. So
I like the thought of a mature stock, though.
It is.
Yes. It's a very well-rounded stock that will meet you at a bar and buy you a drink.
Very mature.
The stock, buy you a drink.
Your parents will approve of that stock.
These other stocks are out there just living it up, going crazy.
Partying, drinking all the time.
You ever party with Tesla stock? It's crazy.
Oh, my God. Can't take that home to mom.
No.
The highs and lows. Yeah. The highs and lows in there.
We digress.
So the value one are less volatile, as you'd expect.
Yeah.
Example, last year you had the S&P total return negative 18%.
Last year, the whole S&P.
Yes, the whole S&P. But when you look at only the value portion, it was negative 5.
Yeah, it's a pretty big difference. So the growth side was really the weaker link this time.
And usually that is because you can also see it when you look at small cap, and you can see it when you look at tech. All of those are growth, different categories.
Yeah, so I mean, and the point I kind of would like people to take from this is if you have a diverse portfolio, which I think everybody should, and you own a lot of boring companies, not the boring company, by the way. That's entirely different.
That's interestingly a fun stock.
Yes, that is odd. My mind is now blown. But if you buy the boring stocks, the Crafts, the Procters & Gambles, and again, I'm not recommending these stocks. I'm just using them as examples. if you buy these kinds of companies, yeah, the growth potential is probably not 30% a year anymore. It was at one time. Currently, it's now, what's the dividend and can I keep up with inflation? That's really why you're buying those stocks. You believe in those companies. You believe that people are going to be buying diapers and toothpaste and mayonnaise and ketchup and all the things that we go to the grocery store every single month or week sometimes. So, again, it's not going to be a sexy situation. It's not going to be something you can brag to your friends at a cocktail party, but it's also not going to let you down, as witnessed by last year, where you're talking about a value index, or the value portion of the S&P was down 5. The S&P itself was down 18, which means the growth side blew up, probably down 25-30%.
Oh, yeah, easy.
Yeah.
If you look at NASDAQ, it was down 33.
There you go. So, you buckle up when you buy NASDAQ tech-type stocks, and you hope for the best. In long term, it's probably fine, to be fair. If you want a slightly less turbulent ride, you jump on board with your Crafts and your AT&T and Verizon, the boring stuff. Again, not to be confused with the Elon Musk version of boring stocks.
Well, I think we're safe there because it's not private. Sorry, it's not public.
Oh, okay, good.
I think it's private.
Good. Well, he's got his hands full right now cleaning up some debris from around the launch pad right now.
Yeah, that was a funny one to see because I love watching the rocket coverage live.
Yeah,
because you just watch them and they're like, we're so excited for this SpaceX, this Falcon 9 rocket. It's going to propel us to the moon, and oh no, well. These things happen. Yeah. They immediately shift into what's going on. It's like, we actually expected this.
Yeah.
And it's probably going to happen maybe 3 to 4 more times. It does. It's no big deal. What is happening?
Oh, but all of a sudden, our signups for astronauts drop dramatically.
Oh, yeah.
Yeah, I'm going to think, maybe not the next launch. I'm good. Let's wait a while.
Yeah.
They call it, they didn't call it what it is. They call it involuntary disbursement or something.
Oh, involuntary disbursement.
Yeah. Disassembly.
Oh, involuntary disassembly.
Yeah, that's what they call it.
It's a wardrobe malfunction.
It is.
I'm like, what?
It didn't blow up. It had a voluntary disassemblage. Yes, I get it. I'm with you now.
Just very excited to go to the moon.
Well, let's shift gears, if we will, from rocket debris onto less interesting topic, which is taxes.
Yay! Wait.
Yeah,
tricked me.
Yeah, I did trick you. So, Ryan? What's your take on the tax situation? Are you all filed? Are you good to go? Is the IRS happy with you? Are they coming to get you? What's happening?
It's hilarious.
It's hilarious. Taxes are hilarious.
That's the status. Hilarious.
No, I had to file an extension because I got a lot of 1099s, and then I've got a very successful kettle corn business.
I'm aware
that I have to get all the paperwork in order for as well.
Yeah,
and also I forgot it was tax day.
Yeah, so. Yeah, that can happen. It can happen to anyone. I'm sure the IRS is very forgiving of that. They just say I forgot.
Yeah,
and they're like, there's probably a I forgot form.
Yeah. Well, the dog ate my taxes. Has worked pretty well for me.
Yeah.
But I find it frustrating, to be honest with you. Every time I fill out my taxes, I just get mad because I'm like, this system doesn't need to be this way in the first place. And it's because of companies like TurboTax lobbying for their own existence.
Yep.
When I learned about how certain European countries do their taxes, where they just send you the bill, like they know. And our government does know how much you owe already. They could do it this way.
They could.
But they don't, and they just ruin a Saturday for me once a year.
Yeah, I mean, it's people say, well, why is there no flat tax? That makes the most sense. Well, that's exactly why there's no flat tax, right? Because there's entire industries, multi-billion-dollar consulting firms who will go unnamed, but I think they're the big four now, and others like TurboTax and people like that their whole job is a complicated tax code. The more complicated the tax code, the better. If you're a tax attorney, if you're TurboTax, if you're Ernst & Young, if you're one of these giant consulting firms, your whole day is spent trying to figure out loopholes in the tax code, and how those loopholes got there is you lobbied to put them there, right? So we could go on and on about flat taxes and if that would be good or that would be bad, but the biggest issue we have with flat taxes is it would put a lot of people out of work. So that's an impediment to us getting there. Don't kid yourself. It's for any other reason. It's simply because the complication of the tax code brings a lot of jobs. And nobody wants to say, all right, let's everybody pay 13% and then like 800,000 people lose their jobs, right? We could do that. It would be more efficient. We could probably reduce the size of government by a quarter if we did it that way, which would make a lot of people happy. But, we're not in the business of making a lot of people happy. We're in the business of making lobbyists happy. So that's where we stand. But we can't fix that on this show, but what we can talk about is what you can do to lower your tax bill.
Yeah, I like this.
Yeah, this is the cool part.
Sounds good, right?
I'm telling you after the fact, so you're welcome. But the reality is there's many neat ways. The first one is if your employer has a tax-qualified retirement plan, you can put money in a 401k. Each dollar you put in is tax deductible. Now, of course, everybody says, but I got to pay when I take it out. I get that. I understand. But in the meantime, it's worth about, on average, 25 or 30 cents on the dollar to you. So where else can you put your money, right? You take $1 down to the bank. They don't give you 30 cents, but if you put $1 into a 401k, you're instantly saving that. Not to mention the fact that if you put in $1 and it grows to be $2, you don't pay taxes on that, at least the growth side, until that time when you take it out. So your employer 401k is a great way to save taxes. Think of it this way. It costs you 70 cents to invest $1. That's a good way to think about putting money in your 401k. Again, I recognize, don't write to me, don't bother me. I understand it comes out taxable at the end. But there are also Roth options, which are not deductible but tax-free on the back end, and that's a whole other conversation. There's IRAs. A lot of times people who don't have access to an employer-funded plan can do, I think it's now up to like $7,000 a year for people ages 50 and over, and maybe $6,500, give or take. Don't quote me on those numbers, but it's in the neighborhood of what you can do and deduct if you don't have access to a qualified plan. So sometimes people say, well, I can't do an IRA because I have a qualified plan at my employer. So you here at iHeartRadio, Ryan, you have a 401k, and one might think, well, I can't do an IRA because I have a 401k. That's absolutely not true. You can always, and I want everybody out there to listen to me, you can always do an IRA. The question is it deductible, right? So if your income is over a certain amount, and it's in the mid 100s now to upper 100s for a married couple. If you make 180 grand, yeah, you probably can't write it off. If you make less than that, there's a pretty good chance you could write some of it off. So if you'd rather have an IRA, let's say your employer doesn't match, right? I think it's foolish to do any kind of IRA if you haven't maxed out your employer's matching contribution, right, Tammy? So, if they say we'll match you 100% on the first 3% of your income, you make $100,000 a year. That first $3,000 that you put in, you've made 100% on, because they're going to put $3,000 right on top of it. Now you may say, but beyond that, Scott, I don't really want to use my company's 401k because they have these mutual funds, and I don't love all these mutual funds. I'd rather put the difference that I want to save, the next $5,000 I want to save, I want to put that in a brokerage account or an IRA with a brokerage firm or with Robinhood or E-Trade or whoever it is, because I want to buy Amazon or I want to buy Netflix or I want to buy Kraft or Procter & Gamble, and I can't do that in my 401k, right? Because most 401ks have a canned menu of things. Mm-hmm. Most of those things are either ETFs or mutual funds. And yes, it's somewhat limited menu, but please don't let that be a deterrent, because again, think about investing that 70 cents to invest $1 because you get the tax deduction, and on top of that, whatever your employer is going to match, you should certainly take full advantage of.
All right. Well, we got more awesome tips and tricks and tomfoolery in general with more It's Only Money when we come back. And while you're waiting, go to the website, edgewaterfamilywealth.com, and we'll be right back with more It's Only Money. Welcome back to It's Only Money with financial advisor Scott Brown and Tammy with Edgewater Family Wealth. EdgewaterFamilyWealth.com, of course, is that website, and it is that time of the year where tax time. Did you do it on time? Are you late? Either way, we got more fun info for you with Scott and Tammy. And Scott, as we're going to break, we're talking about your 401ks and IRAs and the differences and how to get money on top of it without being taxed a little bit.
Yeah, I mean, I think it's tax time, right? So it's fresh on everybody's mind for a minute anyway. But yeah, like right now we were talking about the limits on 401ks. I mean, an individual can actually put, if you're under the age of 50, you can put about $22,500 a year into one. And I know that's a heavy lift for a lot of people. Don't get freaked out. And I'll say this before I carry on with the rest of the limits, is one of the things that people, especially young people, is making what they believe is a meaningful contribution. For years, I spoke to hundreds of people a month about 401ks and using their plan and maximizing the benefit that they have through their employer. And what I would say is a lot of times young people I can only put $25 a paycheck or $50 a paycheck, and it would be a deterrent to them. And they would say, well, because if you hear a number like 22,000 and you make 40,000, you're kind of like, I don't think that's going to work. I could retire well, but I will not be able to eat until then.
I won't make it to retirement because I've starved to death.
Yes, exactly.
Yeah, that'll be hard.
Yeah, so I totally get that. I only tell you these limits as maybe an aspirational thing. Someday down the road when you're 40s and you're in 45 or 50 in your maximum earning years, that's when you'll probably load the boat if you can. But what I don't want people to do is say, well, I'll wait till my income's such that I can put $500 a month or $1,000 a month. Because, Scott, that's meaningful. Yes, but for the last 10 years, let's say you decide to do that at 40, for the last 15 years, you could have put a few thousand a year away, right? And you could have $100,000 to start with when you start putting the more meaningful, in your words, amount away. It's all meaningful. But the excuse I hear a lot from young people is, well, what difference does it make? I'm only going to be able to put 50 a month or 100. I got news for you. If you're 24, 25, 27, it makes a huge difference. So you should do $50. You should do $100. And the other thing that does is it develops your muscle memory, as we say in sports, right? It develops a discipline. It develops your like, I haven't looked at my statement in 6 months or 8 months or 10 months, and gosh, I have $7,000 in that darn thing. I wasn't even paying attention, right? And that's how that happens. Because a lot of people listening to this are thinking, well, you got to pay attention. You got to trade your mutual funds. You got to get in this and get out of that. No, you don't. Just buy a nice S&P 500 growth fund. Throw your money in there. Let your employer throw some money on top of it and watch tax-deferred compounding interest do its thing. Don't overthink it. So to finish the numbers, a person over the age of 50, of which there's only one in this room, can do $30,000 a year. So, if you're a person in your 50s and you're a little behind, but you're making good dough, maybe it's time to get serious. And you have the ability to think about it. If you put $30,000 in a 401k and deduct it on the deductible side, that's probably worth, $7,000, $8,000 worth of tax savings to that person. By golly, that's worth doing, don't you think?
Of course.
Yeah, on top of the $30,000 that you get to keep also.
Yes, it's not a bad thing. And then the other thing that I get frustrated sometimes with, I'm an old guy, so I get frustrated a lot. But the other thing I get frustrated with is people overthinking what they put the money in. Somebody will say, well, but Scott, I'm very conservative. Okay, great. Put it in something conservative. Every 401k has a money market or a fixed bucket paying 3 or 4 or 5%, or a really short-term bond fund that pays, averages 4% a year, or some combination of bonds and stocks that's very conservative. Every plan has some kind of guy like me or gal that's running around a suit, and they're more than willing to answer your questions and help you pick something that fits that description. There's no right or wrong, and this is the difficulty you have with 401ks because they are group plans. Right? There's always a lot of chatter in the lunchroom or a lot of talk around the water cooler about what are you doing in your 401k? And there's always the one dude, and he's always the genius. I moved from this to that, and then from that to this, and from the other thing to this other. I moved from A to B to C to D, and that's the right thing to do. And then all the people around the water cooler are frozen because they're like, I don't do that. Is that the thing to do? And, listen, do your thing. Ignore the other people. Do what works for you. Again, if you want to get rich slowly and you want a conservative vehicle, and for you that helps you sleep at night and more importantly helps you keep the money invested so that you don't panic every time the market goes down, good for you. If you're an aggressive person, you're 23 years old, you're like, I ain't touching this money for 30 years, let her rip, man. Buy all growth stocks. Buy the 90% aggressive thing. But don't be chasing it around. If it drops, don't get out of it because you're defeating the purpose, right? It's going to drop. But also remember, every time it drops, that dollar you're putting in is buying more shares than the month before. So the tax implications are the bait. It's the government has come up with qualified plans back 30 years ago when they did this legislation because they knew the pension was going the way of the dodo bird. A lot of these companies who had put pensions in place back in the 40s and 50s. It was a wonderful benefit. My dad worked for the St. Pete Times for 37 years. He got a really nice pension when he retired. That doesn't happen for most people. If you're military, if you're a government employee, I think teachers have a really nice pension if they stick with it. But most of us are not going to have that. So they came up with the 401k. And again, the bait was, well, if you save for yourself, we'll give you a little bit of a tax deduction. And while that's cool, I'm all for it, and that's a wonderful thing I also take advantage of. I would say the primary reason you should be doing it is because you want to enjoy your retirement.
My favorite thing about it was I worked at a restaurant for a long time, and you make less than minimum wage. You can make like waiter's wage or whatever, and I think by the time I was done, it was like $4 an hour or something. But I would never get a check. It would just be it would all go to taxes.
Right.
And then I realized, oh wait a minute, my employer does have a 401k plan. And then I just said, put 100% of my check, which wasn't that much because the hourly didn't really matter, but just 100% in it. Then I just get all of the money.
Yep.
And I always forget I have this account because I hadn't worked at this restaurant forever. But all of my iHeart stuff and most of my financial stuff is in apps so I can look at it. But I have this one account with Mutual of Omaha.
Yeah.
That I set all of the things to be super aggressive, like, I don't know, 15 years ago. And I purposely forget about that account, like in my brain, and I will only look at it if the market's doing really well. And I'll look at that thing and I'm like, yeah, look at that. Look at old spaghetti serving Ryan making the right decisions back in the day. Because when you get a $0 paycheck, it hurts.
Yeah.
You know, and then at the end of the year, you got to factor it all in. And then I would have to pay taxes a lot of the time. And that was super frustrating. So I found it to be like this, like, I'm cheating the system and no one knows to do that. But I would tell my waiter friends, I'd be like, you should do this. And they're like, no, why would I do that? Every now and then it's a $3 check. I might need that $3.
Yes.
No.
Yes. So you were living on tips, basically.
Yes.
Yeah. So you'd pocket your tips and then deduct the rest of it that was coming from that nominal per hour thing they were giving you.
100%. And then, of course, I'm claiming 100% of my tips.
10-4, yeah, because that's how you roll. Yes, because everybody does that. Wink, wink, wink. So taxes are a thing. One of the things that we do in our office quite a bit is we'll do tax loss harvesting. That's actually part of Tammy's job. Is it
organic?
It is organic harvesting. Organic, yeah, yes. We don't use any chemicals.
No chemicals.
There's no chemicals used. No animals are harmed. No. It's all very natural. Yeah. No hormones. No antibiotics. It's straight up harvesting.
Yeah, I'm just picturing Tammy out there with a thresher and the field's made of money, and he's just like.
Exactly. That's exactly organic, man.
Yeah.
Organic.
That's how we do it. So, with that said. What he does is he harvests these losses throughout the year. So let's say you're a person who has a $200,000 account. You're an entrepreneur, you're whatever, and somewhere along the year, Tammy, of the 10 stocks we own or 20 stocks or whatever the number is, he sees 2 are not doing well. Like Microsoft and Apple are down, just to make something up. And he says, oh, well, there's a $10,000 loss. We don't expect it to be permanent, but right now they're down. Let's harvest that loss. Let's sell those stocks. Let's move them to something else that's the equivalent and put that loss, if you will, in our pocket, right? So if it was, let's say it was a $10,000 loss. So we get to the end of the year, the client comes in, it's January, they're preparing to do their taxes, say, hey, I just sold this piece of property and I made $25,000 on the sale. I'm going to get crushed by the IRS in capital gains tax. We got good news for you. We harvested, so Tammy looks in his loss pocket and says, we harvested this $10,000 loss back in March. Right? Remember that conversation? I said, yeah, I do remember. Oh, my goodness, that's going to save me like $5,000. That's wonderful, or $3,000 or whatever the number is, right? So if you have an advisory relationship, remember, you should be having a conversation with your advisor. Probably if it's a sizable account and it's taxable, doesn't apply as much to qualified accounts like IRAs and things, but to a taxable account, certainly if you have stocks in a taxable account, you should be able to talk to your advisor say every quarter and say, hey, is there any losses I can harvest for the next 30 or however many days in order to possibly wash out some gains down the road? Because a lot of times people don't want to sell stocks because of the tax implications, right? So you bought Microsoft and it doubled and your 10,000 is 20,000. You're like, I think the ride is over, whatever wisdom you used to come to that conclusion. But now you're like, I can't sell because I got to pay taxes on the 10 grand I made. But if you had sold a stock 6 months ago that was at a loss, you get to use that loss against the gain. Does that make sense?
Scott, you're not only a genius, but you explained that to me like I was like a 5-year-old, and I totally got it. I've also been wondering, why is Tammy's pockets jingling all the time? It's just losses. The losses he harvests, he carries them in his pocket.
That's right.
But that's the kind of stuff you want to do. I mean, if you're going out there alone, I mean, you feel like you know money. Trust me, you do not. These are the experts you want to talk to at Edgewater Family Wealth, and they know all the tricks and the tactics, and they are very personable people. You want to work with them. EdgewaterFamilyWealth.com, and we'll be right back with more It's Only Money. Welcome back to It's Only Money here on the radio, your podcast, the internet, whatever you're listening to. We are here with financial advisors Tammy and Scott Brown of Edgewater Family Wealth. You heard the bumper. EdgewaterFamilyWealth.com is the website you want to go to for all of the blogs, the financial talks, plus links to past shows. You know you can get this show on the iHeartRadio app, Scott?
Is that right?
It is right. We're there. There's all kinds of podcasts, but you don't want to listen to those because those don't help you financially. I don't think Behind the Bastards is giving you fun stock advice.
No. Freakonomics, no. Joe Rogan, no.
No. More like no Rogan.
No Rogan.
We should go to war with another like podcast or radio show, 90s style.
Yeah, the unfortunate thing is they wouldn't be aware we were at war with them. Only we would know.
Be like going to war, like we're a tiny child going to war with a full adult. They're just like, I don't even.
They would hold our head with their hand. Yeah.
But yeah, I have some stuff I want to talk about because I am always, and listeners who know me and listen to me on the Monsters, I'm eating up with the AI. But here's the problem with the AI and everything that's going on. First of all, there's companies that are just slapping the word AI onto things.
Yeah.
And it seems to help their market share a little bit because you say AI to people, it's one of those words that people think they understand.
Yeah.
But if you broke it down and you ask them to explain it, they have no idea.
No.
So a lot of companies are doing that, but ChatGPT and OpenAI being one of the biggest ones because just it's fascinating.
It's like when I was a kid. You know, we all had old cars, you know, because that's what you got when you were a kid back in the day, and it was always an ad like for new cars, and it would be like the new Dodge or Ford Mustang with McPherson struts. And as kids, we'd always say we had McPherson struts. We had no idea what McPherson struts were, but we just wanted our friends to know that our cars had McPherson struts. To this day, I don't know what a McPherson strut is.
It sounds like a made-up word.
But I think it's like AI.
But yeah, with AI generally, and like it's adversarial machine learning. Adversarial learning is basically you throw all of the data at something. And over time, you say, well, it puts out outputs, and you go, not that, keep on going, and eventually it gets better and better with the outputs. The stock market is a lot of data over a very long period of time coming from all over the place. They're saying now that ChatGPT is able to not only predict stocks and movement of stocks, but also they can decode Fed speak, so to speak. So, like, you guys, that's essentially your job, too. And you were saying, like, the guy just flat out said the quiet part out loud.
Right.
About that we didn't expect the market to do that well.
Who saw this coming?
That one's easy to read, right?
Yes.
But this thing is supposed to, because of all the data and all the time, all the magazine articles, everything that's happened, it's like, this you can go break it down in plain language, essentially, and do it. Good and bad implications for that at the same time, because it's always going to be dated information.
Sure.
You know,
and it comes from where? It comes from people.
Exactly.
People information they're disseminating.
Have you had the chance to mess around with it all? Because it's getting better, because now they've connected it to the internet, which I think is a terrible plan. But it only had data up until like 2021.
Right.
And so if you would ask it anything current, it would just be like, I don't know what you're talking about.
Is that how it sounds?
Or it would lie to you, because they do this thing. They hallucinate is what they call it in the industry, where like they'll just start making up stuff.
Yeah. I know people like that.
but I imagine there's a lot of like BS and in your business as well. Do you ever see like adding something to this to like the full workflow, or is it?
Well, I mean, it's not like this hasn't, to some degree, been tried. I mean, the algorithms have been built using reams of data from historical trading. historical market fluctuations. Tammy has access to any historical simulation you want to do. If I say, hey, what is a portfolio with 30% bonds, 20% cash, 15% asteroids, and I don't know what, he can go back and say, yeah, this is what it did. That doesn't mean that's what it's going to do, because remember, the markets are really the collective psyche of a nation, in this case, America, right? So if hundreds of thousands, if not millions of people are trading on a daily basis on the New York Stock Exchange or the NASDAQ, and it's what their collective feelings are that day. So for artificial intelligence to collect a bunch of data, historical information from what happened on Thursday at 3 o'clock when the Fed said this, these are different people making different trades for different reasons. So I'm not saying it's not helpful. It's helpful for simulation purposes to say what are the possible outcomes, but the outcome, no, I don't believe that's a thing, because there's again, let's say it did figure it out. Let's say it said if you bought 100 shares of Microsoft on the third Thursday of every month and you did it at 9:42 a.m. and you held it for 7 minutes, then this thing would happen, right? So eventually, everybody would buy on the third Thursday at 9:42 and hold it for 7 seconds, nullifying what was just determined, right? Because the trend would immediately end, because everybody then piled in instead of buying on Friday or Tuesday or whatever. It's kind of self-defeating, right? That's why algorithms don't work, because there have been plenty of people put out algorithms, hedge fund managers and the like, saying, this is what you need to do. And again, it's that kind of stuff. You hold for 37 days, and then you do this, and then you do that, and you throw some paprika in there and some ginger and stir it, and this is what happens. But then everybody does it, and it nullifies the outcome, right? Because now you've changed the whole dynamic of the situation. So I don't want to say it's nothing. It's like the blockchain or the crypto conversation. It's not nothing. It's not to be dismissed. It's not to say there won't eventually be some valid uses for these things. In fact, if you're a kid writing a term paper, I assume ChatGPT is very useful to you right now, right? But there certainly is no quick fix or algorithm that you can build that is A plus B equals I get rich.
Gotcha. Just for funsies, I was like, hey, ChatGPT, what are some questions to ask a financial advisor?
Oh, boy.
And I'm going to hit you. I'm using ChatGPT 4.
Let me have it.
So
I'm not afraid of the computer.
All right. Let's talk about it. Very, right out the gate. Very
Isn't
aggressive.
this what happened in Tron, the movie?
Yes.
Am I going to end up sucked into the computer?
Yeah, very much so.
All right.
Question number 1, hard-hitting question. What sets you apart from other financial advisors, and why should I choose to work with you?
Well, I have a really nice hat.
Nice.
Yes. What sets us apart? Well, I mean, I don't. First of all, the answer to that question is, we're conscientious. But there's lots of people who do what we do. For me to say I'm the only, or our team, Tammy and I's team, is the only team in town that's nice and thoughtful and works hard and does smart stuff. That's not true. There's plenty of teams in town. I have good friends that are in quote unquote competing firms that are very smart. If I had to give my money to 2 or 3 of them, I wouldn't have a problem with it. They do a fantastic job and work very hard for their clients. So what sets us apart as a team is probably the depth of the offering. Most advisors historically, and don't quote me on the exact figures here, but I would say the average financial advisor in the city of Orlando probably shares an assistant with at least one other advisor. So that means there's the advisor and half an assistant, right? Our team is 5 deep. Just for my clients alone, I have a CFA who's Tammy. I have a planner. I have an assistant, and I have 2 junior advisors. So if I'm off goofing around, there are 4 other supremely qualified people available to that client who do different things at different times. So I think what sets us apart is the depth. And I will happily tell you there are 4 or 5 other teams in town who do the exact same thing the exact same way I do.
I would say, and I have talked to other financial people, the difference between you guys and the average ones is you guys seem to care. And also you have the secret weapon in Tammy who cares about these numbers in a way that I've never seen somebody care about numbers and financial charts and this kind of stuff that he legit loves it.
Yeah, he's weird.
Yeah, I know.
Yeah.
But we love him. We love him. No.
I love that you love me.
Yeah, no, we do love him, and that's not to be. I mean, you're not wrong. I mean,
I know.
Tammy absolutely, and I can tell you a story. Like yesterday, I said to him, "Hey, I'm talking to these two clients in the morning, and I'd love to have a dashboard that I could show them their positions in this particular way, because I thought it would be more meaningful to the client than just seeing some statement with a bunch of data on it. So he came up with this graphical formation that was all color, and it showed the positions. It showed the percentage of the positions as opposed to the portfolio. It showed the return of each of the top 10 positions. It showed what section. It was just very, very deep and meaningful and very explainable. And the reason it's notable is because he shot it to me at 1 o'clock in the morning.
I didn't notice the time.
Yeah, it was.
Wow.
So I woke up. I'm 58, so I had to go to the bathroom, of course, for the 8th time that night. And I looked at my phone, and I'm like, what the heck? Go to sleep. So you're right. That is what separates our team from some of the others in town. And again, I don't want to dismiss the idea or have the idea out there that there aren't great teams in town other than ours. There definitely are. But there is a level of caring. I've gotten to this point after 36 years in the business. I'm not afraid to tell somebody when they're full of it, whether that's a client or otherwise, because it doesn't do me any good to make somebody feel good about something that's not going to work. And I think if you're looking for an honest opinion, you need to be willing to take it. And that's a big problem with a lot of advisors, is they're not willing to tell somebody that something that makes them uncomfortable because they don't want to lose the account. Right? I literally had a very uncomfortable conversation with a client today about a situation that was untenable to me and probably untenable to the client, and it went pretty well. They took it well. I was in a position, they respected me enough to take the uncomfortable news and adjust their behavior.
So you get a talented financial team. You get Scott telling you like it is. And you got Tammy making charts at 1 a.m. What more could you want with Edgewater?
True story.
Yeah.
True story.
So if you want to get a hold of these gentlemen and work with one of the best teams, because now I have to say one of the best teams because Scott can't toot his own damn horn. But I would say best team in Orlando, Edgewater Family Wealth. Check out the website, and we'll be back next time with more It's Only Money here on whatever you're listening to.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, they're people, they're regular people.
Now that guy I trust.
Yeah,
See, the problem, Scott, you don't have a monocle.
Monocle is, now, if you can meet a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth, Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc., member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.